Welcome to a pivotal episode of AltFinance, the funding frontier, the podcast that demystifies the vast and often complex world of non-traditional financing for the visionary entrepreneur and the ambitious small business owner. I am Jason Feimster, the architect behind Moonshine Capital, and your navigator through the intricate landscape of alternative finance. Today, we embark on an exploration of an invaluable financial instrument has the power to swiftly transform your business's financial trajectory, factoring. In this episode, we're not just scratching the surface. We're diving deep into the essence of factoring, unveiling what it is, dissecting how it functions, and illuminating the myriad ways it can catalyze your business's cash flow and expansion. Factoring is more than a financial stopgap. It's a strategic accelerator for businesses ready to scale, but constrained by the timing of receivables. It's about turning what you already own into immediate operational fuel. Our journey today will unravel the complexities of factoring, providing you with a clear blueprint to leverage this tool effectively. We'll explore its historical roots, the mechanics of turning invoices into immediate cash, and how to navigate the selection of a factoring partner that aligns with your business ethos and financial aspirations. Whether you're looking to stabilize your cash flow, seize growth opportunities, or simply gain a competitive edge, factoring holds the key to unlocking the liquidity locked away in outstanding invoices. So let's venture together into the realm of factoring, armed with the insights and knowledge to transform potential into prosperity. As we peel back the layers of this financial strategy, you'll discover how to harness the power of your receivables, turning them into working capital your business needs, not just to survive, but to flourish and thrive in today's competitive market. Understanding factoring. Factoring, at its core, is a financial strategy that converts your outstanding invoices into immediate cash, offering a lifeline to businesses bogged down by slow-paying customers. This method has been around for centuries, tracing its roots back to the Mesopotamian traders and later being adopted by merchants across ancient Rome and Europe. It's a testament to the enduring need for liquidity in commerce, evolving through the ages to suit the dynamic landscape of modern business. The essence of factoring lies in its simplicity and the immediate relief it provides to cash-strapped businesses. When you opt for factoring, you're essentially engaging in a partnership with a factoring company. This company, or factor, purchases your account receivables at a discount, providing you with up to 90% of the invoice value almost instantly. The remaining balance, minus a fee, is paid to you once the customer settles the invoice. This setup not only injects quick cash into your operations, but also outsources the burden of chasing up on payments, allowing you to focus on what you do best, running your business. There are two main types of factoring: recourse and non-recourse. Recourse factoring is where the business retains the risk of non-payment. If your customer fails to pay the invoice, you're responsible for buying it back from the factor. This arrangement is typically cheaper since the factor assumes less risk. On the other hand, non-recourse factoring transfers the risk of non-payment to the factor, offering you a greater peace of mind, but usually at a higher cost. The choice between the two depends on your risk tolerance and cash flow needs. The mechanics of factoring are straightforward, yet powerful. Let's say you own a manufacturing company and you've just delivered a large order to a retailer, issuing an invoice for $100,000 with a 60-day payment terms. Instead of waiting 2 months for payment, you approach a factoring company. After evaluating the creditworthiness of your customer, the factor agrees to buy your invoice for 90% of its value up front, giving you $90,000 immediately. Once the retailer pays the invoice, the factor pays you the remaining 10% minus their fees, which can range from 1.5 to 5% of the invoice value. This process not only bolsters your cash flow, but also removes the administrative hassle of collections from your team's responsibilities. Factoring is not a loan. It's a sale of assets, meaning it doesn't add debt to your balance sheet. This distinction is crucial for businesses keen on maintaining healthy debt ratios and for those who may not qualify for traditional bank loans due to stringent credit requirements or lack of collateral. Moreover, factoring can be a scalable solution. As your sales grow, so does the amount of funding you can access through factoring, making it an ideal tool for businesses in growth mode. In the next segment, we'll dive into the tangible benefits of factoring for entrepreneurs, highlighting how this financial tool not only stabilizes, but can also accelerate your business's growth trajectory. The benefits of factoring for entrepreneurs. For entrepreneurs navigating the choppy waters of business cash flow, factoring emerges as a beacon of hope, offering not just immediate liquidity, but a suite of benefits tailored to the needs of growing businesses. Let's delve into the myriad advantages that factoring holds for entrepreneurs, illustrating why this financing option is more than just a quick cash fix. It's a strategic tool for sustainable growth. Immediate cash flow improvement. The most evident and immediate benefit of factoring is the swift access to cash. In a business landscape where timing can be as critical as the quality of your product or service, the ability to convert your invoices into cash within 24 to 48 hours is a game changer. This rapid infusion of funds means you can meet payroll, settle supplier bills, and invest in growth opportunities without the strain of waiting for customers to pay. For instance, a tech startup with a lean cash reserve can use factoring to ensure they have the funds to keep their development team on board and maintain momentum in product innovation. Enhanced cash flow management. Factoring provides a predictable cash flow, enabling entrepreneurs to plan and budget with greater accuracy. By converting receivables into cash as soon as they're billed, you eliminate the uncertainty and variability of customer payment cycles. This predictability is invaluable for businesses that operate on thin margins or have seasonal fluctuations, as it allows for more strategic financial planning and investment. Moreover, with the factor taking on the responsibility of collecting payments, entrepreneurs can redirect their focus and resources from chasing invoices to core business activities, further optimizing operational efficiency. Debt-free financing. Unlike traditional loans that increase your company's debt load, factoring is an off-balance sheet transaction that doesn't incur debt. This aspect is particularly appealing for businesses keen on maintaining a strong balance sheet or those looking to avoid the compounding interest and stringent repayment schedule associated with loans. By leveraging your unpaid invoices, you're not borrowing money, you're accessing the funds your business has already earned. This debt free approach to financing can be a critical factor in maintaining financial flexibility and solvency, especially for startups and small businesses with limited access to traditional banking services. Access to growth capital without dilution. For entrepreneurs wary of equity financing dilution, factoring presents a compelling alternative. It allows you to fund expansion projects, increase inventory, or invest in marketing efforts without relinquishing a portion of your company's equity. This benefit ensures that while your business grows, your ownership and control remain intact. A real world example of this advantage can be seen in a manufacturing company that used factoring to finance the purchase of new equipment, thereby increasing production capacity without seeking external investors. Credit management and risk reduction. Factoring also offers an indirect benefit in terms of credit management. Factors typically conduct credit checks on your customers before purchasing invoices, providing you with valuable insights into your customers' creditworthiness. This service can help you avoid doing business with high risk clients likely to default on payments. Additionally, in the case of non recourse factoring, the factor assumes the risk of non payment, offering you a layer of protection against bad debt. This risk mitigation can be particularly valuable for businesses that operate in volatile markets or with customer base that has varying credit profiles. In the subsequent section, we'll explore how to navigate the landscape of factoring companies, focusing on key considerations to ensure you select a partner that aligns with your business needs and goals. As we peel back the layers of factoring's benefit, it becomes clear that this financing option offers much more than just quick cash. It provides a foundation for strategic financial management and growth. Stay tuned as we guide you through choosing the right factoring company, a critical step in leveraging the full potential of your invoices to fuel your business's success. How to choose a factoring company. Selecting the right factoring company is pivotal for entrepreneurs looking to leverage their accounts receivable for immediate financial gain. This decision can significantly impact your cash flow, customer relationships, and overall financial strategy. As we delve into this crucial process, keep in mind that the best factoring partner is one that aligns with your business's unique needs and goals. Here are key considerations to guide you in making an informed choice. Understand the fee structure. The cost of factoring, often represented as a percentage of the invoice value, can vary widely among providers. It's essential to fully understand how a factoring company's fees are structured. Some companies may offer a flat fee, while others use a tiered system based on how long an invoice remains unpaid. Additional fees for services such as money transfers, monthly minimums, or invoice processing may also apply. Transparency is key. Ensure that the company provides a clear, comprehensive explanation of its fee structure to avoid any surprises down the line. For example, a factoring company might charge 2% for invoices paid within 30 days, but 3% for those paid within 60 days, with additional transactional fees per invoice. Evaluate contract terms. Factoring contracts can range from month-to-month agreements to year-long commitments. It's important to consider the length of the contract, notice periods for termination, and any penalties for early withdrawal. Some factoring companies require a minimum volume of invoices or a certain dollar amount to be factored each month. These terms can either offer the flexibility your business needs or lock you into an unfavorable agreement. For instance, a seasonal business might prefer a factoring company that allows for fluctuations in invoice volume without penalizing for lower activity periods. Access the factoring company's reputation and reliability. Research the factoring company's track record and reputation within your industry. Testimonials, case studies, and reviews from other businesses can provide valuable insights into the company's reliability, customer service quality, and efficiency in processing invoices and payments. A factoring company with a strong understanding of your industry can also offer tailored advice and services that add value beyond mere financing. Networking with peers or consulting industry associations can uncover recommendations and warnings based on firsthand experience. Understand the fine print. Carefully review the agreement for any hidden fees, conditions, or clauses that could affect your business. This includes understanding the recourse and non-recourse terms, how the factor handles delinquent accounts, and your responsibilities in the factoring agreement. It's advisable to have a legal advisor review the contract to ensure that it aligns with your business's interests and to clarify any complex legal language. Consider the factor's client interaction philosophy. Since the factoring company will be directly interacting with your customers when collecting payments, their approach to customer service is crucial. The factor's demeanor and professionalism can reflect on your business, making it essential to choose a partner that values and respects your customer relationships. Discuss with potential factors how they handle collections and ensure their practices align with your standards to maintain positive client relationships. Real world example: selecting a factoring partner. Take the case of a small but rapidly growing organic food distributor that turned to factoring to stabilize cash flow and fund expansion into new markets. By prioritizing factoring company with expertise in food and beverage industry, transparent fees, and a flexible contract, the distributor was able to secure favorable terms that supported growth without straining customer relationships. The chosen factoring partner offered a non-recourse factoring agreement with competitive fees and demonstrated a respectful, efficient approach to collections, ensuring the distributor's clients were treated with care. In the next segment, we'll walk through the process of factoring from invoice to cash, providing a step-by-step guide to help you navigate this financial strategy successfully. Choosing the right factoring company is just the beginning. Knowing how to efficiently manage the factoring process can maximize your benefits and streamline your operations for long-term success. Stay with us as we explore the nuts and bolts of turning your invoices into immediate working capital. The process of factoring. Factoring can transform your business's financial landscape by providing a steady stream of cash flow, but navigating the process efficiently requires a clear understanding of each step. From choosing a factoring company to receiving your funds, This guide will walk you through the factoring process, ensuring you can leverage this financial strategy to its fullest potential. Step 1. Choose a factoring company. After considering the factors outlined in the previous section, select a factoring company that aligns with your business needs. Ensure their fee structure, contract terms, industry expertise, and approach to customer interactions fit your requirements. It's also important to assess their application process, speed of funding, and any additional services they offer, such as online account management or credit checks on potential customers. Step 2. Set up your account. Once you've chosen a factoring company, the next step is to set up your account. This process typically involves submitting an application, providing detailed information about your business, and presenting financial documents. These may include your company's accounts receivable and payable, business tax returns, and a list of customers. The factoring company will conduct due diligence to assess your credit worthiness and that of your customers. This phase is crucial for establishing trust and ensuring that the factor is comfortable taking on your invoices. Step 3. Submit your invoices. After your account is set up, you can begin submitting invoices for factoring. You'll need to decide which invoices you want to sell based on your cash flow needs and the terms you've negotiated with your factoring partner. Most factoring companies allow for electronic submission of invoices, making the process quick and efficient. It's essential to include all relevant documentation, such as proof of delivery or service completion, to ensure the factor can verify the invoice and expedite funding. Step 4. Verification and advance. Upon receiving your invoices, the factoring company will then verify them with your customers to confirm their validity and the terms of payment. Once verified, the factor will advance you a percentage of the invoice value, typically between 70 and 90%, depending on your agreement. This advance can be deposited directly into your bank account, often within 24 to 48 hours of submission. This immediate access to funds allows you to cover operational costs, invest in growth opportunities, or manage any immediate financial needs. Step 5. Customer payment and settlement. Your customers will make payment directly to the factoring company according to the terms of the invoice. The factor handles all aspects of collections, relieving you of the burden and administrative overhead of chasing payments. Once your customer pays the invoice in full, the factoring company will pay you the remaining balance of the invoice amount, minus their fees. This final step closes the loop on the factoring process, with your business receiving the full value of the invoice over 2 payments. Navigating challenges. While factoring provides numerous benefits, it's important to navigate its challenges with strategic planning. Effective communication with both your factoring partner and your customers is key to a smooth process. Ensure your customers understand the role of the factoring company and maintain open lines of communication to address any concerns or questions they may have. Maximizing the benefits. To maximize the benefits of factoring, regularly review your factoring agreements and assess its impact on your cash flow and business growth. Consider adjusting the volume of invoices factored, renegotiating terms, or switching to a different factoring company if your business needs change. In summary, factoring can be a straightforward and effective way to boost your business's cash flow and financial stability. By understanding and efficiently managing the process from invoice to cash, you can harness the full potential of this financing strategy to support and grow your business. As we move forward, we'll explore how factoring compares to other financing options, helping you make informed decisions about the best financial strategies for your enterprise. Stay tuned as we continue to unlock the secrets of alternative financing and its role in driving business success. Factoring versus other financing options. In the diverse landscape of business financing, factoring stands out for its unique advantages, especially for businesses seeking quick access to cash without the burden of debt. However, understanding how factoring compares to other financing options can help entrepreneurs make informed decisions about which financial strategies best suit their needs. Let's explore how factoring stacks up against traditional loans, lines of credit, and other forms of alternative financing. Factoring versus traditional bank loans. Traditional bank loans are a common source of financing for businesses. They offer a lump sum of money up front, which is then repaid over time with interest. While bank loans can provide significant capital, they come with stringent qualification criteria, including credit history, collateral, and profitability requirements. This can make it difficult for small businesses or those with less than perfect credit to qualify. Additionally, bank loans increase your company's debt load, which can impact your ability to secure future financing. In contrast, factoring provides immediate access to cash based on the value of your invoices, not your creditworthiness. It does not add debt to your balance sheet, as it's the sale of an asset rather than a loan. This makes factoring an attractive option for businesses looking for a quick liquidity boost without the long term commitment of a loan. Factoring versus lines of credit. Lines of credit offer businesses flexibility, allowing them to draw funds up to a certain limit and pay interest only on the amount used. This can be a great tool for managing cash flow fluctuations. However, like bank loans, lines of credit require good credit and may necessitate collateral. They also involve a more complicated application process and periodic reviews, which can limit their accessibility and immediacy. Factoring, on the other hand, is more focused on the creditworthiness of your customers rather than your business. It can be set up relatively quickly, providing a more immediate solution to cash flow needs. The simplicity and speed of accessing funds through factoring can be crucial for businesses needing to pay expenses or seize growth opportunities without delay. Factoring versus merchant cash advances. Merchant cash advances, MCAs, provide funds based on future credit card sales, requiring businesses to pay a portion of their daily credit card income until the advance is repaid. MCAs can be easier to qualify for than traditional loans, but often come with higher costs and less favorable terms. The daily repayment requirement can strain cash flow, making it less desirable option for businesses with fluctuating sales. Factoring offers more predictable and potentially less expensive financing solution. Since repayment is tied to the payment habits of invoice customers rather than daily sales, businesses have a clearer understanding of their cash flow situation. Additionally, factoring fees are typically lower than the effective rates charged on MCAs, making it a more cost-effective option for many businesses. Factoring versus revenue-based financing. Revenue-based financing allows businesses to raise capital by pledging a percentage of future revenues in exchange for upfront cash. This option is attractive for businesses with strong revenue projections, but may not suit those with variable income streams. The repayment amount adjusts with revenue, which can help during slower periods, but also means giving up a larger share of income during peak times. Factoring provides a more immediate and straightforward approach to financing, with costs and repayment terms that are clear from the onset. It's particularly suited for businesses that invoice their customers and need to bridge the gap between billing and receiving payment. Conclusion. Each financing option has its strengths and context in which it excels. Factoring stands out for its quick access to cash, simplicity, and the fact that it does not incur debt or require perfect credit. It's particularly beneficial for businesses with reliable customers but long payment terms, providing a vital cash flow solution that allows them to continue operating and growing without interruption. Remember that the choice of financing should align with your business's specific needs, financial health, and strategic goals. Factoring, with its unique set of advantages, could be the key to unlocking your business's potential, ensuring you have the cash flow needed to thrive in today's competitive market. Success stories and case studies. In the world of business financing, real world examples shine a light on the transformative power of strategic decisions. Factoring, as a financial tool, has been a cornerstone for many businesses, enabling them to overcome liquidity challenges and achieve remarkable growth. Let's explore some success stories and case studies that underscore the impact of factoring on businesses across various industries. Case study 1: the manufacturing comeback. A mid-sized manufacturing company specializing in automotive parts faced a significant challenge. Their growth was hampered by extended payment terms demanded by their large clients, leading to a strained cash flow. With traditional financing routes proving inadequate due to the cyclical nature of their industry, the company turned to factoring as a solution. By selling their invoices at a discount to a factoring company, they were able to receive about 85% of the invoice value up front, injecting much needed liquidity into their operations. This immediate cash flow boost allowed them to meet their operational costs, invest in raw materials for new orders, and even negotiate better terms with suppliers. Within a year, the company was not only stabilized but also expanded its production capacity, reporting a 30% increase in sales. Factoring became an integral part of their financial strategy, supporting their turnaround and growth. Case Study 2: The Tech Startup's Expansion. In the competitive tech industry, a fast-growing software startup found itself in a common predicament. Rapid growth was leading to cash flow shortfalls, with significant revenue tied up in long payment cycles from their business customers. Traditional equity financing was an option, but the founders were wary of diluting their ownership. The solution came in the form of non-recourse factoring, which allowed them to leverage their outstanding invoices for immediate cash, without taking on debt or giving up equity. This strategic move enabled the startup to continue its aggressive R&D investments and expand its market reach without interruption. The decision to use factoring facilitated a 40% growth in revenue and helped the company secure a leading position in its niche. The startup's success story became a testament to the effectiveness of factoring in fueling growth while preserving equity. Case Study 3: Bridging the Gap in the Fashion Industry. A small fashion retailer, despite having a loyal customer base and strong sales, struggled with seasonal cash flow fluctuations. The gap between peak sales periods and the off-season created financial pressures that made it difficult to manage inventory effectively. By partnering with a factoring company familiar with the fashion industry's unique challenges, the retailer was able to smooth out its cash flow throughout the year. This arrangement provided the retailer with the funds to purchase inventory ahead of peak seasons and take advantage of supplier discounts for early payments. As a result, the retailer saw a 25% increase in profit margins due to better inventory management and reduced costs. Factoring not only alleviated their cash flow issues, but also contributed to more strategic inventory and financial management. Conclusion: these stories highlight the versatility and impact of factoring across different business models and industries. Whether it's facilitating a manufacturing company's comeback, enabling a tech startup's rapid expansion, or smoothing a retailer's seasonal cash flow, factoring provides businesses with the financial agility to navigate challenges and seize growth opportunities. It's clear that factoring is more than just a financial stopgap. It's a strategic tool that can play a critical role in a business's success story. For entrepreneurs and business owners seeking flexibility, efficient financing solutions, factoring offers a compelling option worth considering. As we wrap up this insightful journey through Invoices to Cash, an entrepreneur's guide to factoring, it's clear that factoring is not merely a financial lifeline, but a strategic tool that can be harnessed to unlock a business's potential. Through our exploration of what factoring is, its benefits, how to choose the right factoring company, and the step-by-step process involved, we've uncovered the transformative impact this form of financing can have on a business's cash flow, growth, and overall financial health. The real-world success stories and case studies we delve into illustrate the power of factoring across various sectors, from manufacturing and technology to fashion. These narratives highlight not just the versatility of factoring as a financial solution, but also its role in enabling businesses to overcome liquidity challenges, seize growth opportunities, and achieve their strategic objectives. Factoring stands out in the landscape of financing options for its ability to provide immediate access to funds, its flexibility, and the unique advantage of not adding debt to a company's balance sheet. By converting outstanding invoices into cash, businesses can maintain a steady cash flow, invest in growth initiatives, and navigate the uncertainties of the market with confidence. As we conclude, remember that choosing the right financing strategy is critical to your business's success. Factoring, with its myriad benefits, may be the key to unlocking the liquidity your business needs to thrive. However, it's essential to consider your specific needs, industry dynamics, and financial goals when deciding if factoring is the right option for you. Thank you for joining us on this episode of AltFinance, the funding frontier. We hope you've gained valuable insights into how factoring can be a pivotal part of your business's financial strategy. Stay tuned for more episodes where we'll continue to explore alternative financing solutions, providing you with the knowledge and inspiration to navigate the complex world of finance and propel your business to new heights. In the dynamic world of entrepreneurship, understanding and leveraging the right financial tools can make all the difference. Whether you're looking to stabilize your cash flow, fuel your business's growth, or navigate financial challenges, factoring offers a pathway to achieving your goals with agility and confidence. We look forward to guiding you through more financial frontiers, offering the insights and strategies you need to succeed. Until next time, keep pushing the boundaries of what's possible for your business, and remember, the right financing solution can be the catalyst that transforms challenges into opportunities for growth.